Hi, welcome to iEducator. This is Teacher Jeff. I'm an educator and an engineer by profession. And today we will discuss Chapter 10. And Chapter 10 is all about management accounting techniques for planning and controlling. And in today's lesson, there are 8 key areas that I'm going to be highlighting today. First, we have the introduction. Second, we have the sales volume increases. Third, sales volume decreases. Fourth, we have the manager's role. Fifth, we have the margin of safety. Sixth, we have the multiple products break-even point. Seventh, we have how to choose cost structure. And finally, we have operating leverage. And right now, let me discuss to you first the introductory part of this lesson. Now, as you can notice, cost volume profit analysis is an important component of a manager's life as he manages a business enterprise. Now, this involves interrelationship between cost, volume, and profit. And this interrelationship focuses on the following 5 elements that a manager should fully understand in order to be effective and to give the best of what owners want from him. And these elements are: first, we have prices of products. Second, we have volume or level of activity. Third, we have variable cost per unit. Fourth, we have total fixed cost. And finally, we have product mix sold. Now, in today's lesson, managers make decisions daily that include marketing strategy, products to be manufactured and later to be sold, and the pricing strategy to follow, and the facilities that will equip the company in doing all these business activity. Now, the components of income statement using variable costing method. Below is an example of an income statement with the components mentioned above. Now, in this case, this is an income statement of Grand Lecas Incorporated for the period ending December 31st, 2013. As you can notice, the sales represent 1,500 units sold by the company during period with a selling price of 400 pesos, and the variable cost represents the cost of the 1,500 units sold at 240 pesos. Now, it can be observed that the variable cost increased in direct proportion with the sales, which means that as sales increase, the cost of sales will also increase. And the difference between the sales and variable cost is contribution margin. The fixed cost of the company should not exceed its contribution margin. Otherwise, losses will occur. Fixed costs are costs that the company incurs regardless of the volume of production or transaction. And the second key area that we're going to be discussing right now, that would be sales volume increases. Now, observe the following example shown below. This is still an income statement of Grand Lecas Incorporated for the period ending December 31st, 2013. As you can see in figure 10.2, this is an example of income statement with increased sales volume. As you can see, as the total number of units sold increases from 1,500 units in the previous example to 2,500 units, the sales and the variable cost increase in direct proportion, while the fixed cost has remained constant regardless of the volume of sales. The company profits increased from 60,000 pesos to 220,000 pesos. And on the other hand, for the sales volume decreases, observe the following example shown below. And again, this is still an example of an income statement of Grand Lecas Incorporated for the period ending December 31st, 2013. And as you can see on figure 10.3, this is an example of income statement with decreased sales volume. Now, as you can notice, as the sales decrease to 1,000 units, so will the variable cost in direct proportion, and the fixed cost remain constant throughout the operation. This time, the company suffered a loss because of the reduced operation. And in a period of no sales, in a period of zero sales, will the company still incur cost? Now, the answer is yes. The company will still incur cost because fixed costs will be incurred regardless of sales. See illustration below. So this is an example of, again, an income statement of Grand Lecas Incorporated for the period of, or for the period ending December 31st, 2013. And as you can see in figure 10.4, this is an example of income statement with zero sales. As you can see, you have there a sales of 0 units. So the per unit is 400. And so for that matter, 400 multiplied by 0, then of course that is 0. Less variable cost of 0 multiplied by per unit of 240 pesos, that's still equivalent to 0. And therefore, our contribution margin is 0. So as you can notice, our fixed expenses is 180,000, and therefore 0 minus 180,000, therefore our net loss is equivalent to negative 180,000 pesos. And going back to what I have just mentioned earlier, in a period of zero sales, will the company still incur costs? Again, the answer is yes, because fixed costs will be incurred regardless of sales. And the next key area that we're going to be discussing right now, that would be the manager's role. Now, the previous illustrations showcase the effect of an increase and decrease in sales to the company's operating performance. The manager of the company should take hold of this most important tool so he can perform better within the owner's expectation. Now, the question is, at what level should the company operate to hit the break-even point? Now, when we say break-even or break-even point, it is that level of operation where the company is operating without profit or loss. This means to say that the sales and the variable cost plus the fixed cost are equal. While it is true that there is no manager who would plan to operate at break-even, this plan could still help managers assess in what particular part of the cost component they should exercise more control so that the profit will increase. Now, how do we compute the break-even point then? Now, there are two ways of computing the break-even point. First, we have the units break-even point, and second, we have the peso break-even point. And so for that matter, in order for us to better understand these two ways, let me discuss to you first the first way in computing the break-even point, which is a break-even point in units. Now, the formula for this is as follows. So break-even point in units is equal to fixed cost all over contribution margin per unit. Now, in order for us to better understand this, let me show you an example. So to apply the formula on the Grand Lecas income statement, so fixed cost, we have there 180,000 pesos divided by with the contribution margin per unit of 160,000, and therefore our break-even point in units, that would be 1,125. Again, this is the application for the computation of break-even point in units. Now, how do we prove this answer then? Now, to prove this answer, a new income statement of Grand Lecas Corporation based on the sales of 1,125 units may be prepared. Now, as you can see on the figure 10.6, this is an example of break-even income statement, okay? So again, based on our computation for our sales is 1,125 units. And as you can see on the right side, its per unit is equivalent to 400 pesos. And therefore, 1,125 units multiplied by 400 pesos, that would be equivalent to 450,000 pesos, less the variable cost, 270,000 pesos. So a total of 180,000 pesos for our contribution margin, less our fixed expenses of 180,000 pesos, and therefore our net loss, that would be 0 peso. So as you can notice, if the total number of units sold is only 1,125 units, therefore, the operation results in a break-even point. So there is neither an income or loss, okay? So the other way in computing the break-even point, that would be break-even point in peso. And the formula of break-even point in peso, again, that's not units, it's in peso. That's typo error. So the formula for break-even point in peso, that would be equal to fixed cost all over contribution margin ratio. Now, in order to apply this formula in the Grand Lecas income statement, our fixed cost is 180,000, and our contribution margin divided by contribution margin of 40%, and therefore our break-even point in peso, that would be 450,000 pesos. Again, this is the application for the computation of break-even in peso. And how do we prove this answer then? Now, to prove this answer, a new income statement of Grand Lecas Corporation based on the sales of 450,000 pesos may be prepared as this. Okay, so you have there the income statement of Grand Lecas Incorporated for the period ending December 31st, 2013. And as you can see, as computed, our sales is 450,000 less the variable cost of 270,000, a total of 180,000 contribution margin, deducted by the fixed expenses of 180,000, and therefore our net loss, that would be 0. Again, this is the break-even income statement. So after learning the break-even point, we will then proceed to other considerations in cost, volume, profit analysis. And that would be our next key area, which is the margin of safety. So what is meant by margin of safety then? If it's a margin of safety, this is the excess of sales or current sales structure over the break-even point. This method will allow the company to view the amount of sales to drop before losses can begin to creep in. Now, the formula in getting margin of safety, so we can make use of two formulas. First, we have sales minus break-even point in peso, or margin of safety all over sales. Now, based on the income statement, in order for us to better understand a margin of safety, let us have an example. So based on the income statement of Grand Lecas, so for the period ending December 31st, 2013, so as you can notice, you have their sales, 1,500 units, and its per unit is worth 400 pesos, and therefore that would be equivalent to 600,000, less the variable cost of 360,000, and therefore our contribution margin is 240,000, less our fixed expenses of 180,000, and therefore our net income that would be 60,000 pesos. And this is the break-even point as computed earlier. As you can see, we have their fixed cost of 180,000 and divided by the contribution margin of 40%, and therefore our break-even point in peso, that would be 450,000. So how do we calculate then our margin of safety? This is now how our margin of safety is being calculated. So the formula that we will be using for the margin of safety, that would be our first formula. So we have their sales minus the break-even point in pesos. So going back here, so our sales in this case is amounting to 600,000 pesos minus the break-even point of 450,000 pesos, and therefore our margin of safety is 150,000 pesos. Now, the computation in figure 10.11 shows that the company can only reduce its sales up to a maximum of 150,000 pesos. Otherwise, losses will occur, and therefore, the manager of a business should be able to minimize the reduction of sales within the margin of safety. And the next key area that we're going to be discussing right now, that would be multiple product break-even point. Now, multiple product break-even point can work only if the sales mix has remained constant. This can be achieved using the average contribution margin per unit, or the average contribution margin to sales ratio per unit of all products together. Now, in order for us to better understand this, let us have an illustrative example. So as you can see, we have there three products. In this case, we have product A, product B, and product C. For product A, the selling price is 100. For product B, that's 80. And for product C, that's 60. For the variable cost for product A, that would be 40. Product B, that's 30. And product C, that's 20. And therefore, the contribution margin for our product A, that would be 100 minus 40, that would be 60. For product B, that's 80 minus 30, that would be 50. And for product C, that would be 60 minus 20, that would be 40. And the number of units sold in response to product A, that would be 2,000, 3,000 for product B, and for product C, that would be 5,000. And therefore, the fixed factory overhead for the year, that would be equivalent to 800,000. And again, this is an example of illustrative problem on multiple products break-even point. So the next question is, what are the requirements in computing for the break-even level of sales? Now, the requirements in computing for the break-even level of sales is given below. Now, as you can see, for products A, B, and C, the contribution margin with respect to product A, that would be 60. For product B, that would be 50. For product C, that would be 40. And remember that the number of units sold in product A, that would be 2,000. And therefore, 2,000 multiplied by 60, that would be 120,000 in total for product A. For product B, the number of units sold is 3,000, and 3,000 multiplied by the contribution margin rather, which is 50. So that would be amounting to 150,000. And for product C, the number of units sold is 5,000 units multiplied by the contribution margin of 40, and therefore the total is 200,000. Now the total contribution margin then, so that would be 120,000 plus 150,000, so that would be 270,000 plus 200,000, and therefore our total contribution margin is 470,000. So we need to divide this one by the units sold. So the total number of units sold for product A, that's 2,000, plus product B, 3,000, plus product C, 5,000, and therefore the total number of units sold is 10,000. Therefore, 470,000 divided by 10,000 units, therefore the average CM per unit, or the average contribution margin per unit, that would be 47. Now, the next thing that we need to do is to get the total units sold. Now, in order to get that, or in order to calculate that, we need to have the fixed factory overhead for the year first, which was 800,000. That would be divided by the average contribution margin per unit, which is 47, and therefore the resulting value, that would be 17,021. So that's the number of units sold, 17,021 units. And again, since we have already calculated the average CM per unit and the number of units sold, we are now able to compute for the break-even level of sales for each product. Now, for product A, you have their ratio of 0.2 divided by 10. Units sold, that would be 17,021 units. For the average number of units, that would be 3,404. The sales price is 100, and therefore the total break-even revenue, that would be 340,425.53. So that would be in terms of peso. And for product B, the total break-even revenue, that's 408,510 pesos and 64 cents. And for product C, that would be 510,638 pesos and 30 cents. And therefore, the total break-even revenue is 1,259,574 pesos and 47 cents. Now, how do we prove this answer then? Now, to prove the answer in the previous slide, so as shown in figure 10.4, this is an example of computed break-even point. Now, remember, based on our calculation here, our total break-even revenue is 1,259,574 pesos and 47 cents, right? So that would be our sales in this case. For our total variable cost, you have there 459,574.47. And this is the sum of the total variable cost for each product. And therefore, our contribution margin is 800,000 pesos, less our fixed factory overhead for the year of 800,000 pesos. Therefore, our net income is 0. Okay, so that's just break even. We are not incurring any loss. We are also not having a profit. Okay, we are just having simply break even. Now, how do we choose cost structure then? Now, in the earlier discussion, the focus is on the relationship of variable cost and sales or production. Now, the next topic will discuss the relationship between variable and the fixed cost. Now, which of the following is a better choice for manufacturing company managers then? First, is it high variable cost, low fixed cost, or low variable cost, high fixed cost? Now, consider the two manufacturing companies below having the same line of business, but different ways of handling their operations. Now, company A used the traditional manual method, while company B used modern machine to augment its operation. Now, both companies A and B, as you can notice, have the same net income. Okay, so their net income, as you can see, that's 120,000 pesos, but company A has 60% variable cost with fixed cost of 1,800,000 pesos, while company B has only 40% variable cost with fixed cost of 2,760,000 pesos. Now, which of the companies is vulnerable to downturns of business operation? Now, let us reduce the unit sales to 11,600 units and see what will happen. Now, since we reduce the unit sales to 11,600 units, so what will happen is, going back to our question, what company is vulnerable to sales reduction? Is it company A or company B? And why? Observe and make a decision. Now, let's try to observe them. So, which of the two companies is vulnerable to sales reduction? Is it company A or company B? Now, as you can see, if we will try to base the net income of both companies, company A is way more better compared to company B, right? Because the net income of company A is amounting to 56,000 pesos compared to company B, which only has 24,000 pesos. But going back to our question, which company is more vulnerable to sales reduction? So therefore, seeing this result, company B is clearly way more vulnerable to sales reduction because, as you can notice, the resulting value of its net income is only 24,000, and that's because we decrease the unit sales to 11,600 units only. So how about in a period where there is a sales increase instead of a sales reduction? Now see illustration 10.17 or figure 10.17. Figure 10.17 presents a comparative income statement with increased units of sales. Now, as you can see, if we will try to choose between the two companies as to which of the two companies is way more better if a sales increase instead of sales reduction, then clearly company B is way more better compared to company A, because as you can notice, company B's income statement, or the net income to be specific, is 240,000 pesos compared to company A, which only has 200,000 pesos. So in this case, company B is way more better in a period where there is sales increase instead of a sales reduction. And the next key area that we're gonna be highlighting today, that would be operating leverage. Now, often managers would want to get the best, and they always find ways in getting a better operating performance. They think, communicate, innovative, and try alternatives. Now, according to Garrison and Noreen in managerial accounting, operating leverage is a measure of the extent to which fixed costs are being used in an organization. Now, as discussed earlier, the focus is on the contribution margin as a control measure by which net income can be achieved. Consideration shall be given to fixed costs as another component in the income statement structure, because the higher the fixed cost means the higher the leverage, or the lower the fixed cost means lower leverage. In other words, if the company has high operating leverage, the profit will be very sensitive rather to changes in sales. And so for that matter, a little change in the percentage of sales may yield an increase or decrease in profits. Now, the degree of operating leverage is a measure of the effect of percentage change in sales to profit. Managers can quickly estimate the impact of the percentage of change in sales without the necessity of preparing a detailed income statement. Now, the formula in getting the degree of operating leverage, that would be contribution margin divided by net income. Now, to apply the formula to the example in figure 10.15, so as you can see, our formula for degree of leverage, that would be contribution margin divided by net income. So applying the formula, so we have, as you can see, our contribution margin in figure 10.15, our contribution margin that's amounting to 1,920,000 pesos divided by the net income of 120,000 pesos, and therefore our degree of leverage, that would be 16 or 16 times. Now the resulting figure is 16 or 16 times, right? So what would 16 times mean? Now, if the net income of a company A is 120,000 pesos, then an increase of 10% of sales would mean that profit will increase to 312,000 pesos, and this is computed as 120,000 multiplied by 260%. Now, the details are shown here in figure 10.8. Figure 10.8 shows you the income statement showing the 10% increase and in relation to degree of operating leverage. Now, if the increase in sales is 4%, the profit would be 196,800 pesos. And this is shown in figure 10.19. Now, as you can see in this figure, this shows the income statement showing 4% increase in sales and in relation to the degree of operating leverage. All right, I think that's a good place to stop. If you have questions, please let me know on the comment section below. If you like this video, please don't forget to subscribe and hit the bell button for the latest updates. Thank you.